This analysis and the concluding detailed trend forecast are excerpted from the following article published at the Market Oracle website on the 14th of December 2014. For as long as I can remember, and 2014 has been no exception, the most vocal mantra often heard is one of warnings of an always imminent US dollar collapse, usually as a consequence of reasons such as a soaring debt mountain, deficit spending, money printing, demographics, the rise of China, and of course the death of the petrodollar. However, the dollar for many years has ended each year little changed, where even the recent breakout only puts the US dollar barely 4% outside of its multi-year trading range of between 85 and 79. As the reality is one of all currencies being in a state of perpetual free fall against one another that manifests itself in inflation. Therefore, perceived dollar strength is just as a consequence of the slackening in the rate of US dollar free fall. The US Fed is at the head of a global central banking crime syndicate that seeks to control the world's financial system by means of the US economy operating at a continuous large trade deficit, as the Fed's money printing agenda has been one of inflating the whole world so as to mask inflation as all currencies free fall together. The US Senate report into CIA global torture on a near industrial scale illustrates that the US state will go to any lengths so as to maintain the supremacy of the US dollar as the world's reserve currency. Therefore, most of the world's central banks work towards maintenance of their currency's relative value against the US dollar, which results in collective currency devaluation, where what appears as relatively little change in currency rates marks a real terms flood of fiat money that the consequences of which are exponential inflation, as illustrated by the below US CPI inflation graph. The most recent data puts the US government debt at over $18 trillion. The exponential trend trajectory is best illustrated by the fact that when President Obama first took office, US national debt was around 10 trillion. So roughly, US debt is doubling every 10 years or so. This exponential trend constantly prompts many to jump onto the imminent US dollar collapse bandwagon by being under the impression that the US cannot service its debts, let alone repay the debt, which fails to realize that the debt is never meant to be repaid but perpetually rolled over and inflated away, and that US debt is being monetized through a myriad of scams, one of which is QE, that results in what I've labeled as the quantum of quantitative easing, where the actual debt burden is approximately 1/3 lower than what the official statistics suggest, as a consequence of approximately 1/3 of interest payments made on US government bonds being reimbursed back to the US Treasury by the US Fed Central Bank, that results in exponential real inflation, thus resulting in what is termed as the cost of living crisis. Elliott waves. The Elliott wave pattern suggests that the US dollar has made a fifth wave peak, which implies an ABC correction is now underway that could last a couple of months and could see the US dollar retrace to approximately 85 in an ABC structure. On the longer term, the next major impulse wave, 5, if similar to the last impulse wave, 3, could carry the US dollar index to around 98 during the second half of 2015. Trend analysis. The US dollar has been in a bull market since 2012, therefore probability favors a continuation of this bull market. The current strong uptrend hit long-term resistance along previous highs at between 88 and 89, and has since started to correct. This correction should continue to between 85 and 87 before the USD attempts another breakout to target a break above resistance at 89 to 90. The long-term level around which the US dollar oscillates is 100, as the level that the USD index started off at over 40 years ago, and it's over 14 years since the US dollar last traded at 100, that it could achieve during a spike above USD 100 before the end of 2015. Support and resistance. There is heavy support along preceding highs at 85 then at 79, whilst 90 is a natural resistance level which, if overcome, next resistance will be at 92 to 92.5, beyond which is 98, which suggests that the dollar is going to find it tough to clear overhead resistance and thus expect a far more choppy trend, as the US dollar will need some more time to prepare the ground before clearing overhead resistance. This therefore implies an imminent significant correction that already looks underway. Price targets. On the upside, the dollar index targets 92, then 98, and then 85 to the downside. A trend towards 98 will probably eventually result in a break higher to above 100 during 2015, probably manifesting in a short squeak spike. Crude oil. There is often an inverse relationship between the dollar trend and commodity prices such as crude oil, as illustrated by the crash in the crude oil price that acts as a stimulus to the US economy and the dollar as a consequence of falling energy costs. As there is no sign of an end to the crude oil bear market that appears to be targeting previous multi-year lows along $36, this suggests the US dollar strength could continue for some time until a crude oil price basing pattern starts to materialize, which looks set to coincide with the mid-2015 US dollar peak. Therefore, my US dollar trend forecast conclusion for 2015 is that after the current correction is over by around USD 85, that the US dollar then trends higher towards a target of 98 by late summer 2015, probably terminating in a spike to just above 100 before correcting back toward 92 by the end of the year. Ensure you subscribe to this YouTube channel for ongoing analysis and detailed trend forecasts.